Hello, and welcome to the Policy on Point webinar, Catching Up with Collateral. Before we get started, I want to go over a few housekeeping items. All lines have been muted upon entry and will remain on mute to prevent interference. This session is being recorded and will be available on the Freddie Mac YouTube channel. If you have any objections, please disconnect now. Furthermore, if you have any questions, please enter them in the Q&A box by clicking the three dots located in the bottom right-hand corner of your screen. We will pause for questions at the end of this call. With that, I will hand it over to Jessica Gonzalez. Jessica, the floor is yours.
Thank you, and welcome everyone to Freddie Mac's Policy on Point webinar series. Here with us today are Jackie Doty, Anthony Kelly Morgan, Rico Rowell, and Kevin Sprowski. In a few moments, you'll get the chance to meet them and hear about their topics. In this session, we'll be covering updates and guidance in ACE+PDR, Condo project advisor enhancements, as well as policy considerations and corresponding examples in projects with need of critical repairs. As we continue this webinar series, we'd like to share with everyone the goals we set out to accomplish along the way, to give concise overviews of critical policy changes, and to share best practices, examples, and expert insight into what these changes mean for you. Now let's meet the team.
Hi, everyone, and thank you so much for joining us today. Welcome to this session. I'm Jackie Doty, Director of Freddie Mac's Condo and Co-op Policy Team, which is responsible for developing and managing Freddie Mac's condo and co-op policies, as well as working on innovations like Condo Project Advisor, a tool that helps make condo lending easier for lenders.
Hello, everyone. I'm Tony Kelly Morgan. Having worked 40 plus years in the mortgage industry, I had the good fortune of joining Freddie Mac in 2017, a little over 7 years ago. As a collateral risk project manager in single family quality control, my primary focus is to support QC directors, managers, and underwriters in evaluating condominium and cooperative collateral.
Hello, everyone. I'm Rico Rowell. I'm the Quality Control Collateral Manager for the Single Family Underwriting Department, which is responsible for reviewing loans for data integrity and understanding thoroughness. We identify and analyze a sample of loans to ensure critical data is evaluated according to Freddie Mac's underwriting guidelines.
Good afternoon, everyone. I'm Kevin Sprowski, and I'm in Collateral Policy Senior for Single Family Acquisitions. I'm responsible for both developing and managing collateral policies, which includes our ACE+PDR as part of our appraisal modernization efforts. So as I mentioned, this is Kevin again, and I'm going to start our Policy on Point discussion today by providing some background to one of our newest collateral offerings, ACE+PDR, and then Rico will be walking through some examples of what we actually see in PDRs that we have received. The ACE+PDR solution was implemented in July of 2022 as part of our appraisal modernization effort, and it helps fill the gap between the appraisal waiver, ACE, and a traditional appraisal. The ACE+PDR option allows the seller to accept an appraisal waiver offer and deliver a mortgage with a property data report, or termed PDR, in lieu of obtaining a traditional appraisal. The PDR is an on-site data collection of property characteristics and a robust set of photographs that's performed by a trained property data collector. The seller reviews the PDR to ensure that the property meets Freddie Mac's property eligibility requirements. In other words, it's not going to be a C5, C6, or Q6 condition or quality rating, or identified needed repairs to the property to meet our property eligibility requirements. The benefits of the PDR are identified here on the slide. It can alleviate some of the appraiser capacity issues that we have seen in the recent past. The PDR is eligible for rep and warranty relief for value, and the seller will still be responsible for making reps and warrants for condition and marketability. Additionally, we have seen that there is a potential that turn times can be reduced when obtaining a PDR versus a traditional appraisal, and there may actually be a potential savings in borrower costs associated with originating a mortgage with a PDR that can be dependent on the market and the market area that you're looking at. Selling Guide Section 5602.4 includes the eligibility requirements for an ACE+ PDR offer, and it also provides reference links to other accompanying ACE+ PDR requirements that are in our guide, including but not limited to the topics that are identified here: eligibility, maintaining the eligibility, age of the ACE+ PDR offer, age of the actual property data report, property data collector qualifications and requirements, seller oversight, and the exhibits that are required. So let me highlight a few of these for you. In 5603.6, we have our property data collector qualifications and requirements. Highlighting some of those, the data collector has to be independent and unbiased, having no present or prospective interest or bias with respect to the transaction, the property, or the participants to that transaction. Data collectors must complete training in all aspects of what it takes to collect property data and the data set that we have implemented, which is the Uniform Property Data Set, otherwise acronymed as UPD. Data collectors have to perform the data collection, which includes identifying and reporting with supportive photographs property characteristics that are represented in the data set, the UPD, design factors that impair use of the subject property, which cannot easily be changed, and factors adjacent to the subject property that are atypical for the location. They also have to be trained on measuring the dwelling to produce a building sketch and a floor plan, and to collect a comprehensive set of photographs of the subject property. Along with what the data collector themselves must do, we do have a section that identifies the seller oversight of the property data collector. That's located in 5603.6. And the controls that must be in place include requiring data collectors to undergo periodic background checks that also include a criminal check, requirements for comprehensive training for the data collectors to prepare an accurate and thorough PDR, which are the training requirements that I just outlined previously, require compliance and adherence to a customer service standard or a code of conduct that any other employee or contractor of that seller must also comply, include a process to continuously evaluate data collectors, monitor and document their performance, remedy any deficiencies that they note, and the ability to discontinue use of chronically underperforming data collectors. And they must also include a process for providing continuing education as it becomes required, such as changes in the property data collection method or changes in the data set. And one of the other things that I'll highlight off this page is that we do have requirements related to the age of the PDR offer and the age of the PDR report itself. They're in two different sections, but in 5602.4, we identified that the ACE PDR offer is provided through the LPA feedback certificate, and that message is valid for 120 days. If that offer becomes older than 120 days on the note date, then a resubmission to LPA is required to determine what your ongoing ACE+ PDR eligibility is. In 5604.3, the policy is related to the age of the PDR, which requires that the effective date of the PDR is the date that the data was actually collected. That date must be no more than 12 months prior to the note date. When a PDR is actually more than 12 months old on the note date, the requirement is that a new PDR must be obtained.
Hey, Kevin, before we move forward, I think your camera might be malfunctioning. Do you mind turning it back on for me and turning it off?
Sure.
Thank you. Perfect. There we are. One more time. There you are. We can now see you. Thank you so much. Wait, it went away one more time. Try it one more time.
Sorry.
No, there we go.
There we go.
Thank you. You may now move forward.
When we originally implemented ACE+PDR, we were using a proprietary data set, which was identified as the Freddie Mac PDR version 2.0. Subsequently to that, both Fannie and Freddie worked together to create a uniform property data set that created a standardized data set that was fungible between both GSEs. We published the UPD last July 26, 2023. And with a recent bulletin published last October, we introduced a transition plan that will move sellers from the original Freddie Mac proprietary dataset to the newly created uniform property dataset. The actual transition plan that was identified in that bulletin allowed for use of the new UPD starting with application receive dates that were on or after December 1st of last year. The old dataset could still be used during the transition period after the new one was introduced on December 1st. However, coming up very, very quickly for application receive dates on or after April 1st of 2024, next Monday, sellers must use the UPD only and the Freddie Mac proprietary dataset version 2.0 will no longer be accepted. In conjunction with the UPD, Freddie Mac has also developed the Beyond ACE application programming interface, which I will be referring to throughout the rest of this as the base API. That allows delivery of PDRs and provides feedback messages to sellers to help them assess the PDR. The base API itself became available to all sellers last August 2023, but will become required for applications receive dates on or after April 1st, 2024. Submission to the base does not relieve the seller from assessing the information and the photographs in the PDR to ensure that the property meets our eligibility requirements or may require repairs in order to meet eligibility. In all cases, the seller must retain the PDR in the mortgage file. As I mentioned, sellers are required to review the PDR and ensure that the property does meet Freddie Mac's property eligibility requirements. Freddie Mac's property eligibility requirements are such that a property must meet the condition that meets the condition rating of either a C5 or C6 or a quality rating of Q6 is not eligible for sale to Freddie Mac unless those deficiencies that resulted in that property being rated C5, C6, or Q6 are fixed prior to delivery of the mortgage to Freddie Mac. So if the PDR or the assessment by the seller indicates that repairs are needed, Guide Section 5605.8 provides for the requirements related to obtaining a completion report for that, which we have identified as our PDR completion report. PDR completion report must be performed by the property data collector and must include the data points and certifications that are in our Guide Exhibit 39, photographs of the completed repairs, and that PDR completion report must be dated before the settlement date with Freddie Mac and retained in the mortgage file. If there are inspections that are needed to determine if repairs are required, then also in Guide Section 5605.8, we have included the requirements related to obtaining an inspection from a trained professional in that field of concern. The inspector must provide either a report that states the repairs are not needed, or a signed report or invoice that includes the professional's license number stating that the repairs have been completed. Similar to the PDR completion report, this report or invoice from an inspector must be dated before the settlement date with Freddie Mac and also retained in the mortgage file. So I'd previously mentioned the base API. Well, sellers can leverage the base API feedback messaging to help them gain awareness of and provide special attention to possible condition issues that are a result of the observations noted in the PDR. But I want to stress that it doesn't relieve the responsibility of the seller to review the data and all the photographs in the PDR to ensure that there isn't anything else that they may become aware of from the data and the photographs that might render a property in a C5, C6, or Q6 condition. There are a few other reasons that may indicate the subject is not eligible for the offering, such as if the property is identified as a manufactured home or a 2 to 4 unit that was not evident until the data collector actually visited the property, or has characteristics that would require an appraisal to be obtained. If there is a reason for an appraisal to be obtained, in most cases, a hybrid appraisal may be an option, which would then be completed by an appraiser who leverages the information and photographs in that completed PDR, and the appraiser themselves will complete a hybrid appraisal without the need for the appraiser themselves to complete a personal interior and exterior inspection of that subject property. So a few of the things that are considered as characteristics that might show up on a PDR is if the property is proposed construction. Well, in that case, there's really nothing for the data collector to observe or capture because at that point, there's nothing on the site of this vacant lot. In this particular case, a hybrid appraisal would not necessarily be acceptable because there's nothing for the data collector to complete a PDR to be leveraged by an appraiser. A few of the other characteristics that could be evident is that the property is so unique that it's one of those properties where there are 0 bedrooms and 0 bathrooms above grade because it's built into the side of a hill, and the bedrooms and bathrooms are technically in the lowest level of the property, normally referred to as a basement. We would require an appraiser to go out and visit that property so they can determine if there's any type of impact of value or marketability due to the configuration of that property. If the measured area of living area is less than 400 square feet, an appraisal would also be required so that the appraiser can demonstrate the marketability and value of that type of a size of a home. Or if the property happens to be mixed use, where there's a small element of commercial, such as maybe there's an accountant that has their office located in the home and they allow clients to come where they transact business. This would also require an appraisal for an appraiser to be able to determine the impact to the value and the marketability of a mixed use consideration. At this point, I'd like to introduce Rico, who will be illustrating some examples of the things that we actually see in the PDRs that have been reviewed. Rico?
Thank you, Kevin. I'm going to go examine some of the QC findings of some of the ACE plus PDR reports. This process typically entails various aspects, including data accuracy, completeness, consistency, compliance with Freddie Mac requirements. Let's take a look at our first example. As you can see, the dwelling is under renovation, and the kitchen is partially completed and only a refrigerator is present. The photo shows walls, flooring, and lighting only. The dwelling doesn't have a functional kitchen, which would adversely affect the overall livability of the dwelling. As such, the property would be ineligible in its current condition. The PDR should have been made subject to the completion of the actual kitchen. And there's no evidence within the mortgage file that the kitchen was completed prior to delivery to Freddie Mac. Providing evidence of the completed kitchen with photos is essential to meet required standards to ensure the property's eligibility. Let's move on to the next scenario. Our next scenario actually is a building sketch with the PDR report, which reveals a unique floor plan, which Kevin mentioned before on that. This property has 3 bedrooms located below grade, as you can see in the first photo, and no bedrooms on the second, which is actually above the grade of the property. So it's probably a property that's built sort of the front of the house is kind of built on the hill, what Kevin mentioned before. This unconditional layout may have limited appeal to certain buyers and possess challenges for accurate valuation. The absence of bedrooms above grade deviates from typical property configurations and introduce uncertainties in assuming the property's value and marketability. Freddie Mac has outlined guide section 5604.1c requires special attention to such cases. When there are 0 bedrooms above grade, the PDR must be upgraded either to a full Form 70 appraisal or Form 70H hybrid appraisal report. This ensures more of a comprehensive evaluation of the property's characteristics and mediates the risks associated with unconventional layouts. Furthermore, in many market areas, the absence of bedrooms above grade would be considered sort of a functional obsolescence. This means that such a feature would negatively impact the property's appeal to the actual market value. Therefore, it is critical to engage an appraiser with in-depth knowledge of the market dynamics, specifically understanding the implications of 0 bedrooms above grade in both marketability and market value. All right, let's move on to our last scenario here. Now, again, our last scenario is actually here's a finished basement here. It's been observed there are areas of the ceiling that has damage, existing of the actual, there's tarps, there's a sagging ceiling with apparent water stains, indicating possible interior water damage. Prolonged exposure to water may weaken the building's materials such as wood, drywall, insulation, compromising the structural integrity of the house. Therefore, in accordance with Freddie Mac guidelines, the property would be unacceptable. The plumbing issue must be remediated to prevent against further water damage. The PDR should have been made subject to the remediation of the ceiling damage and a comprehensive plumbing inspection with appropriate documentation to confirm that all issues have been adequately addressed. Water damage within the house can have far-reaching consequences affecting both the structural integrity and the health of its occupants. Recognizing the signs of water damage, especially those indicated by tarps, water stains, musty odors, bubbling drywall, mold, mildew, etc., is critical in addressing and mitigating potential risks. In conclusion, QC finds revealing the need for repairs and noting incomplete aspects of the properties are critical indicators that warrant immediate attention and action. In light of these findings, it is imperative that PDR be made subject to the completion of the noted deficiencies. Addressing these deficiencies promptly is essential to ensure the property meets Freddie Mac requirements. I'm going to actually turn it over to Jackie now to discuss the Condo Project Advisor. Jackie?
Thank you, Rico. We can go to the next slide. So what is Condo Project Advisor? Condo Project Advisor is the Freddie Mac loan advisor tool that allows authorized sellers, lenders who have a contract with Freddie Mac, to submit project waiver requests to easily request unit level exceptions for condominium projects early in the origination process. So lenders can request waivers for a variety of reasons, including delinquent assessments, excessive commercial space, leased amenities, litigation, project unit occupancy, reserves, and single entity ownership. It also allows lenders to obtain feedback about a condo project's compliance with the project review requirements that are assessed by Condo Project Advisor. It's an automated risk tool that can assist lenders in underwriting established condo projects. And it works like this. The lender looks up the project, and within seconds, the tool provides feedback statuses. If the tool provides a green status, that means the project passed all the rules that Condo Project Advisor assessed. And the lender only remains responsible for the guide requirements that Condo Project Advisor does not assess. And the feedback certificate will provide a list of the items that the lender is still responsible for, so that nothing is missed. If you get a yellow feedback, it means that the project failed one or more rules that CPA assesses. Now, that doesn't mean that the project is not eligible. It just means that the lender is responsible for determining if the project actually does meet that requirement. And they're also still responsible for the items that Condo Project Advisor does not assess. If you get an incomplete status, it means that Condo Project Advisor does not have any information about the project, and the lender remains responsible for the entire project review, just like you would have been prior to the introduction of Condo Project Advisor. We also have a status called not eligible. Loans and projects with this status are not eligible to be delivered to Freddie Mac. And we have a status called project certified. And this means that the project has been certified by Condo Project Advisor and very little project underwriting is required. For all of the statuses, the Condo Project Advisor feedback certificate provides a list of items that the lender does remain responsible for so that you don't miss anything. So what are the benefits? Top benefit is to be able to address project risk concerns early in the origination process. So finding out if this could be a potential condo tell on day one, or finding out if there's excessive commercial space on day one. It could also help to reduce borrower costs and turn times by speeding up the underwriting process when the lender does not have to review as many items. And we also, with the project certified status, can help to minimize project underwriting, thereby potentially lowering the cost and the time for the lender. Next slide, please. Now I'm going to share some recent enhancements to Condo Project Advisor. We rolled out a critical repairs message last year, and when a project receives an incomplete status, lenders might see a message for certain projects that may be in need of critical repairs. And this message was designed to support lenders in identifying projects that they might not otherwise be aware of and that may be in need of critical repairs. It's based on a variety of sources. When lenders get this message, they should be extra careful in reviewing these projects for critical repairs. And keep in mind, when you don't get the message, you're still required to determine whether the project is in need of critical repairs. We also introduced a not eligible status to indicate when a project does not meet certain project review and general eligibility requirements. Mortgages secured by units in these projects are ineligible for sale to Freddie Mac. In addition to alerting lenders through Condo Project Advisor, we also provide this warning in Loan Product Advisor, Loan Quality Advisor, and Loan Selling Advisor. Please keep in mind that condominium projects that do not receive a not eligible status must still be assessed for compliance with all applicable requirements. Last July, we introduced a status in Condo Project Advisor called Project Certified. And when lenders receive a Project Certified status for a project, they can deliver loans in that project with minimal project underwriting. You only have to review compliance with the project eligibility guide requirements in our guide that pertain to property insurance, title insurance, leasehold, and a few other small items. And the good news is lenders are not required to review these projects for critical repairs. These project certified decisions may reduce costs for borrowers because lenders may not incur additional fees that are typically passed on to the borrower to obtain condo documents for underwriting purposes. In December, we announced an option for lenders to be able to submit projects to Freddie Mac for a free project certified review. So for certain projects, Condo Project Advisor may specify that a condominium project may be submitted for project certified review. If Condo Project Advisor finds that the condominium project meets the requirements for project certified, the project will be assigned a project certified status. We're very excited about these new enhancements to Condo Project Advisor, and in the future, you can expect to see more options that will help you make more condo loans. Now I'm going to turn to critical repairs and special assessments. So last July, Freddie Mac announced requirements that pertain to physical and financial condition of condo and co-op projects. But before we talk about the policy changes, I'd like to give you a little background as to why Freddie Mac made these changes. Many of you are aware that in 2021, the Champlain Towers South in Surfside, Florida collapsed, which shattered the lives of unit owners and caused the deaths of 98 people. This was a 12-story beachfront condo that had years of deferred maintenance and structural issues that the condo board struggled to fund and remediate. As you're probably familiar, this tragic event was in the news, and a lot of activity around whether projects are meeting critical repairs requirements ensued. Some of you may be wondering if we made our policy changes based on this one tragic event. And the answer to that is no. Unfortunately, the adverse conditions that led to the collapse in Surfside are not uncommon at all. The concerns about aging projects have continued since this collapse, including reports of projects with structural challenges that in some cases have led to immediate evacuations and eventually to project condemnations and terminations. We made these policy changes because condos are a super important segment to Freddie Mac's mission, as we see a very high share of first-time home buyers and low and moderate income buyers in our condo loan purchases. And so the goal of these policy changes is to ensure that all condo buyers can enjoy and maintain long-term sustainable home ownership. Let's talk about the policy itself. Both Fannie and Freddie issued industry announcements in July of 2023 to incorporate prior temporary guidance on deferred maintenance, critical repairs, and special assessments into our respective selling policies. We are continuing to prohibit the sale of condo and co-op loans that are in projects that are in need of critical repairs. And all critical repairs must be complete and issues remediated before loans securing units in the project are sold to Freddie Mac. Now, by critical repairs, we mean repairs and replacements that significantly impact the safety, soundness, structural integrity, or habitability of the project's buildings, or that impact unit values, financial viability, or marketability of the project. These include the bullet points shown on the slide. Some examples are mold, water intrusion, damaging leaks, advanced physical deterioration of load-bearing structures, roof failures, unsafe balconies, cracked foundations, parking structure issues, and other things that, if left uncorrected, could result in a critical element or system failure. We've also seen critical repairs needed to seawalls, elevators, waterproofing systems, stairwells, foundations, electrical systems, and other load-bearing structures. It's also important for you to know that if damage or deferred maintenance is isolated to just one or a few units, it doesn't affect the overall safety, soundness, structural integrity, or habitability of the improvements, then the critical repairs project eligibility requirements do not apply. Now, there's more to tell you about the new policy. We're also prohibiting the sale of condo loans and co-op share loans in projects that have current evacuation orders due to unsafe conditions. We recently saw a project that had to be evacuated with residents given just hours to leave following a structural inspection of the property that showed a concrete beam failing in the garage. Now, some might think that these issues only happen in old projects and high rises, but the reality is these kinds of adverse conditions can happen in any project that fails to address critical repairs and significant deferred maintenance, or fails to obtain timely inspections and implement necessary remediation plans. I want to drive home the point that these requirements are geared to help protect borrowers from physically unsafe or financially unstable projects. They also help lenders identify when these conditions exist so they can work with their customers to address these problems so that the borrower's homeownership journey is safe and financially sustainable over the long run. You might be wondering, what if the project is just making minor repairs? Are those okay? And the answer is yes. Some examples of routine repairs include planned maintenance items that do not impact safety or habitability of the project, such as replacing a roof that's expected to last only 3 more years, updating plumbing or electrical components, updating windows, common areas, floors, carpets, and lights, among others. A delay in these types of repairs would not result in a critical element or system failure. And to help uncover potential critical repairs, we're asking lenders to review any structural or mechanical inspection report that was done within 3 years of the project review date. There must not be any critical repairs needed, as well as no current evacuation orders or similar regulatory actions. Projects in need of critical repairs remain ineligible until the required repairs or inspection report have been completed and documented. Sellers must review an engineering report or substantially similar document to determine that the repairs resolve the building's safety, soundness, structural integrity, or habitability concerns. Now let's talk about special assessments. Special assessments are not always a problem or a bad thing. Sometimes special assessments are for improvements, such as building new recreational facilities or to boost reserves to put the project in a better financial position for the future. But they can also signal that the project is in need of critical repairs, has significant deferred maintenance, or some other issue that has not been adequately budgeted or reserved. For this reason, we're asking lenders to obtain information about all special assessments in the project so they can determine why the project is issuing special assessments and whether those assessments point to a more critical item that needs attention and may cause the project to be ineligible. We're asking lenders to understand the amount of the assessment, the repayment terms, and the history to help determine the overall impact of the assessment on the project's financial sustainability, because when a large portion of unit owners are not paying their special assessments, it puts the entire project at risk of financial and physical deterioration. These are projects that typically do not have financial resources to continue to maintain their buildings and amenities by addressing expensive needed repairs. For both current and planned special assessments, sellers must obtain and review the information for each special assessment to determine if the funds are for a critical repair. Now, whether or not there are special assessments, sellers may need to review a combination of documents to determine whether a project meets our physical condition requirements. And some examples of documents are shown here. This list on the right is not prescriptive or exhaustive. Sellers are responsible for determining which documents they need to review to ensure compliance with the policy requirement. Now I'd like to turn it over to Tony to discuss what the lenders need to have in the loan file and what we have commonly seen in QC. Tony?
Thanks, Jackie. And again, thank you to everyone for joining us on today's Policy on Point webinar, Catching Up with Collateral. In February, we passed the 2-year mark from when Bulletin 2021-38, Temporary Condominium and Cooperative Project Requirements, became effective. As Jackie shared, a guide update effective September 18, 2023, included adding Section 57013N, projects in need of critical repairs. And at that time, the temporary requirements were sunset. Now, for loans delivered to Freddie Mac on or after September 18, 2023, the guide update is followed by QC. However, if a loan was delivered prior to September 18th, QC will continue to follow the 2021-38 requirements for reviewing the eligibility of the collateral. For the next few minutes, I'd like to discuss 4 common themes or patterns that QC has identified as challenging when sellers document the condition of the condominium collateral type. We see the first one on slide 1, and it is the appraisal alone is not sufficient in determining whether there are special assessments or critical repairs. The next slide, we'll be looking at evidence of an internal project approval in and of itself, such as a processor or underwriter cert, when without including project documentation is also not sufficient. The next theme we'll talk about is a project manager or an HOA's refusal to provide information that does not relieve a lender from the responsibility of obtaining the information through other means. A critical repair issue, once disclosed or revealed, they must be addressed. Now, the current slide we're looking at describes where an appraiser would note the existence of a current special assessment for the subject condominium unit. The bullets provide context for why relying on the appraisal alone does not solve for the existence of critical repairs. So let's move on to the next slide. Here we discuss the theme, evidence of internal project approval or certification, such as your processor or underwriter cert, must be accompanied by project documentation when a file is submitted to QC. In the slide, you'll look at certain bullets that also, there's a reminder of how a special assessment might impact the borrower's qualification, shown in the 3rd bullet. And the 4th bullet here describes the best practice in documenting the loan file when a special assessment is paid in full or at closing and is not assumed by the buyer. Now, to jump into a part of the requirements for critical repairs, our collateral team is often asked, what constitutes a substantially similar document in lieu of obtaining an engineer's report? So I'd like to provide here three examples of what might also be required or requested and submitted. One would be when a critical repair involves an extensive repair or a complete replacement of the building's roofing components, a certification of completion, or the roofing contractor's issuance of a warranty specific to the condominium project and the scope of work would be acceptable. The second would be looking at public record. If a permit was required by the association to initiate repairs, the recording of a certificate of occupancy could be documented in the loan file. Now, in Florida, many of you are familiar with the state implementing a 40-year recertification requirement. The Miami-Dade Department of Regulatory and Economic Resources Building Recertification Portal can be accessed without registration to verify a project's status. And let's move to the next slide, please. Now here we're going to discuss the theme, the HOA questionnaire that failed to disclose repairs. Now, the Freddie Mac guide does not actually include a requirement for the completion of a project questionnaire. As Jackie provided earlier, there are alternative documents to determine a project meets our physical condition requirements. Now, that said, over the years, many lenders have found the completion of a questionnaire to be the path of least resistance. Up until completion of questions regarding special assessments or critical repairs, I think we'll all agree that that has been met with some resistance. So we see some examples of responses on the current slide that we see in certain questionnaires. And the respondent might say, oh, I don't know, or there's no critical repairs I'm aware of. Now, my favorite is completing a project Freedom of Information Act form to submit with a request for project information. The question we see in the blue box is pulled from the condominium unit mortgage frequently asked question or facts that can be found on FreddieMac.com FAQs condominium. Now, providing an answer to this question, if the managing agent or HOA refuses to provide the information, the seller must obtain a copy of any inspection completed within 3 years, as Jackie earlier spoke about, and the seller may be able to obtain the information from parties that have an interest in the transaction, such as the unit buyer, the unit seller, the real estate agent, or unit owner for refinance. As we move on to our final slide for this topic, I have to do the same myself. Here we see that the HOA questionnaire that fails to disclose repairs. Oops, I got backwards on my slide. Sorry about that, folks. And our final slide, we discussed the theme. If critical repair issues are disclosed, they must be addressed. There are several bullets explaining why the use of email to establish a condominium project's condition status is discouraged. I think we're all familiar with how information may become diluted when it is passed from person to person to person. I recall a communication exercise done in elementary school. By the time a message is passed from the first to the last child, the resulting message often did not capture any of the original message and was sometimes so different, our best efforts would provide us all with a good laugh. As we come to the end of this section of the webinar, I would like to point you to the final bullet of the current slide. When contracting with a third-party expert to perform condominium project reviews, remember to always include the project documents reviewed in the QC file. And with that, I thank you again and turn back to Jessica and Jackie for the wrap.
Thank you so much, Tony. I believe we have time for one quick question, and this one is regarding ACE+PDR. Is there a specific form required for the property data report?
No, we do not have a specifically prescribed form, such as like the appraisal report forms have been prescribed for a PDR. What we do prescribe is the UPD, the Uniform Property Data Set, and the data elements that must be captured. And the vendor of the seller that they engage can build the property data report output in any manner or fashion that they see fit, provided that all the data elements of the UPD are represented.
Thank you so much, Kevin. And I'd like to hand it over to Jackie if you have any closing remarks for us.
Yes, thank you so much. I just wanted to close by saying that condo and co-op projects are a very critical part of our country's housing supply, and they can often provide an affordable home ownership option for buyers, including first-time home buyers and low to moderate income buyers. Freddie Mac is strongly committed to serving this affordable segment of the market. And as we continue to focus our efforts on lending and condo and co-op projects, we're going to continue to promote prudent risk management practices while helping our lenders with our risk assessment tools like Condo Project Advisor. And together with our lenders and industry participants, we can drive down the costs for home buyers and support affordable and sustainable housing in projects across the nation. Thank you.
Thank you, Jackie. As a reminder, for additional information, we encourage you to take advantage of the training and resources available from the Freddie Mac Learning Center. The call center provides seller servicer support Monday through Friday at 1-800-FREDDIE. And please visit the Freddie Mac single family website at sf.freddiemac.com and stay current with resources there, including the single family seller servicer guide at guide.freddiemac.com. That concludes our presentation today. Thank you to our speakers and to our clients who joined us. As a reminder, if we did not get to answer your questions, we will get back to you directly next week. Thank you and enjoy the rest of your day.